Below 1% then on US 10-year. This is a 150-year first, as Matt was just saying. What is the lower bound for that now, Hugh?
I don't think we know what that is, simply because I think the market is extrapolating now that the Fed are going to find it very difficult to stop. Because in my expectation, the data in the US is going to deteriorate over the coming months as the real impact of this virus starts to feed through. We haven't seen much of the weakening in the US economic data so far. And so as that data starts to print over the coming weeks, pressure is just going to build and build on the Fed to keep delivering more stimulus. And so if they're perceived to be on the way to zero, then I think there's plenty of downside still for US 10-year yields in this scenario.
And plenty of downside for stocks. I mean, Scott Minerd is out there with one opinion. Jim Bianco says it could drop 20. We could see another 20 to 30% decline from here. I think he's talking about the S&P 500. But the problem is, you know, PEs last month for the S&P were 20. So if you have declining economic growth, if you have rates that are falling further, if you have supply and demand problems, then PEs, he argues, should be more like, I think, 10, 11, 12. What do you think, Hugh?
Sure. So for me, I think for this sell-off to find a real floor, then I think you need to see two things, really. The first is that you need to see a peak in the increase in infection rates, and that one we really have to park in the don't know category. Frankly, we can't predict when that's going to come. And then you want, as a second piece, the market's faith in coordinated and targeted fiscal policy backed up by monetary policy to really strengthen. And so there, as we've just been talking about, I think we're starting to see some measures, but the question for me isn't as to when that's going to come, it's more how effectively managed that's going to be, particularly in the European case.